The beautiful thing about crypto is that your bullish or bearishness right now depends on your timeline. If you're focused on the next 3 weeks, it's hard to find someone in crypto that's uber bullish, that's like jamming the buy button. People are tentatively and painfully making small incremental buys if they're gutsy, but no one is like, this thing's going to rip tomorrow. If you ask people, what do you think about the next 3 years? I bet the same people who turned bearish on your show, LG, will say they're very bullish. Because over the next 3 years, you have trillions of dollars of institutional capital moving in, you have the Genius Act going into effect in a year, you have huge growth in stable coins, huge growth in tokenization. It's really hard to be bearish over the long term.
Matt Hougan begins with one of the most striking divergences in today's crypto market. Harvard is buying, Abu Dhabi is buying, institutional allocators are buying, crypto-native retail investors are selling. When 2024 started, the expectation was simple. Institutional demand from ETFs, hedge funds, family offices, sovereign wealth funds, and corporations would easily outweigh any selling pressure from retail. But Hougan admits something surprising. I underestimated how much retail selling we would see. Why? Because retail investors are psyching themselves out ahead of time.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
Right, so if you think about what's going on in the market right now, Harvard is buying and retail is selling, right? Abu Dhabi is buying and crypto natives are selling. And I think when we entered the year, the assumption was that the massive purchases from institutions and corporations would be more than enough to soak up any additional supply from retail selling. And I think the element to which I'm surprised with is that there's more retail selling than I anticipated. I think the thing that I didn't factor in was people, I think, pre-freaking out about the 4-year cycle and wanting to dodge the 30, 40, 50% pullback in the market that they saw coming in 2026. I didn't think about that psychological effect. I think that's what we're living through. I think we have to finish living through it and then we bottom. But I do think we're sort of short-circuiting the 4-year cycle now, probably closer to the bottom than the start. And I think it's still upward over the long period of time. I remember back when Bitcoin first turned down at like 120 and it started going down. I remember more recently when it started to flirt with going below 100K. And Ryan and I had some conversations that Bitcoin is sometimes the canary in the coal mine. Not always, but sometimes it's the most risk-sensitive asset. And it's the first thing people sold. And the thing that was happening outside of crypto was people were starting to worry about the circular nature of AI revenues. They were starting to worry about Jamie Dimon's cockroaches in the private credit market. They were starting to worry about the Fed turning hawkish even as economic conditions worsened. And so the thought that occurred to me when we first started going down was this may not be crypto specific. Crypto may be showing us which way the market's headed. And sure enough, the market did follow that. Like it started to emphasize these negative narratives. You're hearing words like AI bubble more. You're hearing words like consumer credit crunch and delinquencies in auto loans and those sorts of things. And so it occurred to me that, we were so insular in crypto that the thesis I said at the start of this show, that what's causing us to go down is crypto native people worrying about the historical 4-year cycle repeated, is so mirror gazing that maybe I should step back. And actually what's happening is the market is going broadly risk off because of concerns about AI revenue. That's not my base case, but I think it is something worth considering. And that's why I threw that tweet out there. We could see the hopes for a market structure bill in the US Congress get completely derailed. And if that pushes further into 2026, people will lose faith in that will happen. And they'll start to worry about this stronger regulatory footing that's unleashing this entrepreneurial energy that you and I talked about. You could see end of the year tax loss harvesting. People selling because they want to report losses can in fact lead to prices being lower, right? Before we get to the end of the tax year. And then there is a bubbling up concern in the crypto community about quantum risk that I definitely have been sensing from crypto Twitter and a few other spokespeople, To the extent that that becomes an existential worry, I think that could contribute to the bearish sentiment. If we were in a bull market, I think everyone would just shrug their shoulders and be like, yeah, whatever. But in a bear market, they dwell on bad news. And there is this sort of increased focus on quantum risks that I'm hearing from a few sources. The beautiful thing about crypto is that your bullish or bearishness right now depends on your timeline. If you're focused on the next 3 weeks, it's hard to find someone in crypto that's uber bullish, that's like jamming the buy button. People are tentatively and painfully making small incremental buys if they're gutsy. But no one is like, this thing's going to rip tomorrow. If you ask people, what do you think about the next 3 years? I bet the same people who turned bearish on your show, LG, will say they're very bullish. Because over the next 3 years, you have trillions of dollars of institutional capital moving in. You have the Genius Act going into effect in a year. You have huge growth in stablecoins, huge growth in tokenization. It's really hard to be bearish over the long term. So I think the way we thread the needle is we talk to, mostly institutional investors and financial advisors who do move on like a 3 to 5 year time frame. And they're looking at this asset and saying, yeah, looks pretty good. We can buy it at 90 instead of at 125. That's great. So I really think it comes down to time frame. And that's the big discrepancy in crypto right now. Another characteristic of these bear markets is you have to take the hot buzzword and completely kill it, right? So like during the ICO bear market, we had to take ICOs and grind them into the ground. And then we had to take DeFi and take it out back and completely kill it. And then we had to do the same with meme coins and NFTs, right? And then
NFTs,
you didn't get to the bottom until those words were dead. The words for this cycle that we're in the process of killing are DATs, DeFi looping, and the basis trade. And I think those were the 3 things that like bubbled up and everyone was talking about, right? And became common stance. And they're just in the process of being destroyed in the same way that NFTs and meme coins and ICOs were in the past. And probably when we get to the bottom of that, when everyone's like, DeFi looping, are you crazy? That's for degens. That's the point where that's probably exhausted and we're ready to go back up to the races.
Hougan highlights a powerful idea. Traditional finance is heavily governed by self-regulatory organizations, SROs. Like FINRA, these groups aren't government. They are industry-built trust frameworks. Crypto is now doing the same. Coinbase, by acting as a responsible overseer for new ICO structures, is building the crypto version of FINRA. This is how institutional trust is formed. This is how trillions of dollars enter the market. It's not about waiting for Washington. It's about crypto maturing from the inside. Enormous value is being created in crypto's new financial ecosystem.
One way to think about the story of crypto and all these things that become really big deals is that there is an initial version that bubbles up and then people are like, nah, right? There were initial versions of stable coins. There was DAI and such. And then people were like, no. And there were abuses like Luna. And now we're in the stablecoin bull run. When ICOs were happening, back in 2017, 2018, there was a lot about them that was great, right? They allowed retail participation in new engaging ideas. They were an efficient platform for raising money. The problem was they were mostly scams and you couldn't build a token that had real economic value. Those were big problems to be sure. And that's why that died a grisly death and it should have. But there is nothing that made the fundamental act of raising capital not interesting. And if you listen to SEC Chair Paul Atkins, he's now saying you can do ICOs in a well-contained format with proper oversight, and that will be a new way to catalyze capital formation in the US. He said that in a speech in July, and Coinbase is launching it now in November, right? Doing Monad as the first example of an asset. I think it's very possible that next year we see a rebirth of ICOs, of really interesting projects with well-designed tokens that give economic rights to their users. They're not just governance tokens, and that everyone can invest in. And that's a new major way of capital formation. I think it's a pretty big deal. I also do think, to tie to the other point you raised, look, I think everyone's looking at crypto and says we have 3 major use cases. We have Bitcoin as digital gold, we have stable coins, and we have tokenization. I think what's happened is that we've built good infrastructure for 15, 16, 17 years, and we had a hostile regulatory environment that prevented real use cases from entering into the mainstream. And now we've lifted that regulatory lift. And I think Bitcoin, stablecoins, and tokenization is just the tip of the spear. I think we're going to see maybe 6 major use cases bubble up next year. I think you're going to see ICOs bubble up. I think you'll see digital identity. I think you'll see privacy. I think you'll see a DeFi renaissance. I think you'll see a DePIN renaissance. I think thinking that crypto is Bitcoin, stablecoin, and tokenization is like thinking that the internet is email, search, and Amazon. What about social? What about Uber? What about mobile? What about Zoom? What about podcasting? There were a million more use cases. We have not reached the end of history in crypto. We have 3 use cases. We're going to have 30. And I think next year is the year that those are going to start to bubble up into the mainstream. The thing crypto natives may not understand is that a lot of traditional finance operates under what's called self-regulatory organizations, or SROs. As an example, when Ryan and I write content, it has to go to a group called FINRA to make sure that we're not lying about it. FINRA is not a government agency. It's a self-regulatory agency that institutional investors created in financial firms so that the world would trust us, because we created our own regulation that said we're only going to put out information that's trustworthy. And as a result, millions of Americans and Canadians and everyone else trust the content that's put out. This is like an example of that. This is Coinbase doing effectively a self-regulatory organization, saying ICOs had a lot of scams. Rather than wait on Washington to make a format that works, we're going to apply crypto native knowledge to provide an SRO type experience. And I can't tell you how much this accelerated traditional finance. And it's going to do the same here in crypto because you'll be able to trust it. That's why Coinbase specifically is so important in this example. I think there are 2 possible explanations. One is that they were in fact in a bubble, right? If you think about something like Amazon stock after the internet bubble, it took a long time to get back. The business was growing throughout. It ended up being much, much higher, but it took a while to get back to that 2000 era high. So that's one possibility. The second one is the one you mentioned, which is we don't know where value accrues. We know a huge amount of value is being created in this new financial ecosystem. Does it go to Ethereum? Does it go to Chainlink? Does it go to Uniswap? Or does it go to Coinbase? Is like a really good question. The thing I loved about what Ryan said is like, who cares? Just buy them all. If you pick one, then you could be wrong. But so just sort of know your thesis. Are you betting that a lot of value will be created? Then buy them all. Are you betting that the value will be created and it will accrue to the L1 and Solana will be the winner versus ETH? That's a trifecta or something. I don't bet on sports the way Ryan does, so he can correct my terminology. But you have to get all 3 of those things right if you're making that specific bet.
Matt Hougan's analysis paints a realistic yet deeply optimistic picture of where crypto stands today. Yes, the short-term environment is messy. Retail panic, regulatory delays, macro uncertainty, overhyped narratives collapsing, and end-of-year selling. But beneath the surface, the long-term story has never been more compelling. Institutions are buying. Regulation is slowly aligning, infrastructure is finally mature, new use cases are emerging. And the next decade of crypto growth is setting the stage for an explosion of economic innovation. If the short term looks uncertain, zoom out.